Hello and welcome. I'm Andrew Howard, Chief Investment Officer here at Catholic Super, and it's my pleasure to bring you this investment update for the financial year ended 30 June 2023. I'll take you through the performance we've delivered for members this year, and we'll also have a look at what's been unfolding in markets and the economy, both here and around the world. Firstly, I'm pleased to report that for all of our members, it's been a positive year, with positive performance generated across each of our investment options. As an example, members in the high growth options, such as Growth Plus, also enjoyed a very strong year, with this particular investment option delivering an exceptional return of 13.01% to 30 June. So despite a year which has been dominated by headlines focused on rising interest rates, historically high levels of inflation, and the ongoing war in Ukraine, it's really pleasing to see that the fund's long-term investment strategy has navigated these conditions extremely well. In terms of what's driving these strong numbers, we've had double-digit returns from equity markets here in Australia, as well as from overseas. And while that's a great result, and it's certainly helped us deliver strong returns for our members, there does seem to be a bit of a disconnect between the strong results we've been seeing in share markets around the world and the underlying economy. As we know, we've experienced extremely high inflation, peaking at levels not seen in Australia and the US for more than 4 decades. This resulted in central banks taking extraordinary action in a bid to get inflation back down to targeted levels. Here in Australia, the RBA has an inflation target of 2 to 3%, and in the US, the Federal Reserve's inflation target is 2%. The outcome has been sharp increases in interest rates by the RBA beginning at their May meeting last year, with rates increasing from 0.1% to now 4.1% in July of this year. And it has been a similar theme in the US, where the US Federal Reserve has steadily increased rates to 5.25%. However, both here and in the US, there's the expectation that rates will still need to go higher to bring inflation back to target levels. So while we've seen inflation steadily reduce, it's still materially higher than the targets both here and in the US. The reality is that while we might be close to seeing the peak in interest rates, it is important to keep in mind that it is extremely unlikely we'll see them move back down to the levels that we enjoyed for so long after the global financial crisis in 2008, and particularly the record low rates we saw following the onset of COVID in early 2020. Despite this, equity markets have experienced strong rises since their lows of October 2022. And this strong performance is actually counterintuitive to what would usually be expected from equities in a rising interest rate environment. So what can we deduce from all of this? It's certainly been a great year for members, but we don't think investors should be lulled into a false sense of security. In fact, we feel there's a chance that the strong performance in equity markets could potentially be papering over the cracks that lie behind this strong headline performance. To that end, one of the key pillars of our investment strategy is asset allocation. And as long-term investors, we continue to believe that diversification is one of the key ingredients in delivering positive, long-term, real returns for our members. So as equity markets continue to rise and defy expectations of what investors would reasonably expect to happen in a strongly rising interest rate environment, we took the opportunity to trim our equity exposure and reinvest into bonds. For a long period of time, bonds haven't been an attractive investment because of record low interest rates and bond yields close to zero. But with interest rates now higher, bond yields have moved higher, which has given us an attractive entry point to increase our exposure to Australian and global bonds. The result of this shift in asset allocation is that we now have a materially higher allocation of fixed income than the fund has had for many years. The key difference today is that with bond yields where they are, this asset class again has a role to play in providing the portfolio with attractive downside protection. Looking ahead, we wouldn't be surprised to see the current positive momentum in share markets falter at some point. as the reality of higher interest rates begins to have an impact on the underlying economy. Whether this results in, for example, the US economy falling into a recession remains unknown. But with this in mind, we think it's prudent to ensure we have a well-diversified portfolio in place. We're certainly pleased to be able to deliver strong performance to our members for the 2022-23 financial year. As always, our focus remains on ensuring that the portfolio is well placed to navigate both rising and falling markets and provide our members with consistent real returns over the long term. Thank you for watching. If you'd like to find out more information, please head to our website